A warm welcome to the Risk Reversal Podcast. Guy Adami here today. I'm joined by Vishal Garg. He is the CEO and founder of Better Home and Finance. The symbol is BETR. And you have a fascinating story. Thanks for joining us.
Oh, thank you so much for having me. It's awesome to be here.
And it's awesome to have you because I think it comes at the right time. A lot of data has just come out over the last week or so. But before we get sort of granular, people always love hearing the backstories, and you have a great backstory. I think richuncle.com, if memory serves. I mean, you've been at sort of the forefront of a lot of different things. This is the last iteration of sort of your entrepreneurial spirit, and this is one that I think has really got legs. But let's talk about your journey to this point.
Oh, totally. I mean, I dropped out of investment banking. I went on a pitch I was working at Morgan Stanley. I went on a pitch with Mary Meeker, and I was, the analyst hauling the books. And I was like, I'm on the wrong side of the table here. And it was 1998. And I was like, I'm going to go start. I quit the next day. I said, I'm going to go start an internet company. And, people said you should start a company based on something you've had trouble with. So, it was rough to pay for college. I grew up in New York City in Queens, went to Stuyvesant High School. Most of my friends and others were on scholarships. We went into the school that gave us the most money, not the school that we could get into. And so we said, wouldn't it be great if you could go get a student loan instantly and there was someone who could back it and be your rich uncle? So it would be like having everyone has a rich uncle. And so we called it myrichuncle.com. It was great. I took it public when I was 26, built it into the fourth largest student lender in the country. Unfortunately, it folded during the credit crisis. And I went to the other side of the trade where I was helping, consumers refinance or modify their loans. So started doing that for student loans, like 300,000 student loans I got up to a portfolio with. Partner with some cool people, Lou Ranieri, the founder of the mortgage market, some of the big investors out there, Blackstone, others, to go find student loans to buy. And then, started using the same data analytics to figure out how I can modify mortgages. And so partnered up with people to go start buying mortgages. And that's what I was doing, literally helping enable servicers to help modify mortgages based on the consumer's current income, how much their house was worth, how much they could afford to pay, not like what the monthly mortgage statement said. And I went to go buy a house myself. And the process was so broken. And I was like, the internet was invented 20 years ago. This is 2014. And this looks like it's still in the fax era, in Microsoft DOS, floppy disks. And I can go price any loan inside a mortgage-backed securities trust instantly. And yet it takes a major bank 60 days to price a loan, in any major market. And I said, there must be something better. And I kept on looking for something better and I couldn't find it. And so, I took the money that I was going to use for our down payment and instead bought the domain name better.com. And, 10 years later, 100 billion plus loans funded, the biggest FinTech, by loan volume. Here we are today, and we've made home ownership cheaper, faster, and easier for, millions of American consumers. I think we've saved over $8 billion in interest for American families, and we're just getting started.
Yeah, which is not insignificant. But, you said something, well, you said a lot of things, but embedded in there is sort of this Neanderthal approach that the historic lenders have been using for quite some time. But if you think about it, you were going up against a very tried and true, well-established sector that probably was not looking for disruptors like you. So there had to be some difficult times in the early innings of this company, is my sense, just the pushback you got from some of these bigger companies.
Oh, totally. People said it works the way it works. You're not going to disrupt it. Real estate brokers get paid what they get paid, and nobody's been able to change that. Mortgage brokers get paid what they get paid, and nobody's been able to change that. And it's very local, and nobody cares about the internet. I was like, no, hundreds of millions of people have the Zillow app downloaded, they're shopping for houses. What if you could take the process of shopping for a house and make it as simple as, you take out your phone, type in a few pieces of data, take a picture of the house, and we pre-approve you right there for the house you want to buy. And all the data was visible. What was problematic was the entire industry was built on manual processing. People on computers that don't talk to each other and the computers don't talk to each other. And what you could instead do is build a unified database that was capturing data from all these third-party services, income verification, like getting that directly from ADP instead of like having to fill out a form for your like employer to fill out. Tax returns, just getting like that directly from the IRS. Your credit data, getting it from all three bureaus, parsing it and making all that happen. And then doing it all together, all simultaneously, rather than like a person doing one thing, then another person doing another thing, then another person doing another thing, which is what I encountered when I went to a lot of these other guys. And if you could do that, you could take something that took 3 weeks and turn it into 3 minutes. And that's what we did with the BETR.com pre-approval.
And you take the stress out. I mean, don't underestimate. Well, I'm not suggesting you are, but don't underestimate. You're just taking the stress out of the entire process out as well, because I think for most people that have been through the process, it doesn't not get more stressful than that. Just in terms of the duration, and then just day of the amount of forms that need to be filled out and the signatures required. I mean, that's one of, you think about experiences in life. I mean, that's not one you necessarily want to go through a number of times. And to the extent that you can make it streamlined and less painful, I mean, I think you're onto something without question. With that said, let's talk about the landscape, because if you think about it, you're probably at the crossroads of the most economically sensitive industry there is. Home lending and the home ownership market. I mean, we talk about the housing market all the time. So here we are. We're taping this on Friday, September 5th. We had a jobs report earlier that was disappointing. I am certain you watch these things as closely as anybody out there. What's your sort of just broad overview of what's going on here in the United States in terms of the economy?
I think we have a consumer that's run out of steam. I think that's the reality of it. I think, there was this huge stimulus during the pandemic. We had low rates. We had a lot of consumption that was bottled up, but that, burst out. We had the inflation. And I think the consumer is now getting back to where we were, where, we're like economically insecure, we're income insecure. Jobs are not as plentiful as they were before. I think people are scared of AI and what the job market is going to be, particularly if you're in the white collar sector, right? Like AI is not going to replace a plumber, but like AI might replace like a data technician or, an IT worker. And those were like safe jobs. People like signed up for that stuff. And, so they're feeling insecure after a long time. And they're looking for ways to pay down their debt. Americans have amassed $18 trillion of debt. A lot of it in the last 5 years, post the pandemic, kind of continuing the consumption surge that happened like right after the masks came off during the pandemic. And so we've got 18 trillion of debt outstanding. We've got like an unemployment rate up at 4.3%, heading to potentially like what used to be recession times, like 6%. You've been in the business long enough, you know that. And yet what's really interesting is Americans are sitting on 31 trillion of home equity. And, there's a real capacity for someone to come in there and help American families right-size their balance sheet, right? And, really cut down on the monthly interest payment, which is huge. And like we're seeing people come in and get home equity lines of credit that pay off all their other debts. They're, 18% personal loan. They're like 14% auto loan. They're 36% credit card. And there's a real opportunity that is sort of starting to present itself.
Okay, so let's talk about that for a second, because you just did the math, and you know this better than I do. And if I'm wrong, please correct me. But I think right now you mentioned north of $18 trillion of household debt. That's made up over a number of different things. I think credit card debt in the United States is now north of $1.2 trillion. I believe the average rate on a credit card is about 22%. So, you can sort of blend all these things together. And even with interest rates moving higher as they have, I mean, it still seems to make sense, to me at least, if you can tap into that. Your home equity business grew 260% year over year. If you think about that, I mean, that's tremendous growth. And my sense is that will continue. But how are people figuring this out? Because it seems with the traditional lenders, these HELOCs were sort of frozen for a period of time.
Yeah, no, I think banks post the credit crisis were paying people to shut down their home equity lines of credit lines. And the entire product was broken. I remember before the credit crisis, people were saying, oh, but people are using their homes as a credit card to pay for stuff. And so what is interesting, the home equity product went away, right? And the home equity product had gotten pretty much abused, right? You had a combination of ninja mortgages, right? No income, no job, no assets, married to 110 LTV home equity lines of credit. And basically the banks confused like what consumer behavior is when you give somebody like 110% of their house value and you allow them to mail you the keys versus what, judicious consumers kind of need to right size their balance sheet and be able to draw on the home equity. And so the home equity product is really mostly unavailable. Most banks shut down their business in 2008. The technology systems that are there in the industry that make mortgages don't actually even accommodate home equity or home equity lending. And so it's very hard for a traditional bank to say, hey, let me just turn on a home equity lending product. And so that leaves companies like us a pretty big market available to go and help American consumers relearn about the home equity product and learn what it can do for them. Learn that it can help them consolidate all their other debts that they've taken on. All these like asset classes, personal installment loans used to be $100 billion asset class. Now it's $1 trillion asset class because the home equity product went away. Student loans, $200 billion asset class when I used to be in it. Now it's $1 trillion asset class. Again, home equity loans went away. When I was in the student loan business pre-crisis, we didn't compete with other student lenders. We competed with home equity. And so fundamentally, all these products came to being in the past decade and a half, post the financial crisis, because the home equity product went away. And now we're reintroducing the power of the home equity extraction product to consumers, doing it in a judicious way, doing it not at 110 LTV, but doing it at like 65 LTV, 75 LTV, 80 LTVs, things that make sense, putting in a debt to income test that allows consumers to like actually we know that they can afford them. And as a result of that, all the AI that we've put into the process, we can capture all these data elements and get you an approval within 1 minute and get you the money to pay off all your debts, right size your balance sheet. An average customer today is saving $1,100 a month on their monthly debt payments when they're refinancing their other debts with their home equity line of credit. And we do that, in 5 days.
Yeah, there's a lot there to sort of parse through. So let's just talk about AI and the importance of AI, because if you think about it, if you integrate it, the margin improvement or the unit economics, I guess is a phrase, of direct to consumer with the utilization of AI could be pretty, I think, important for your business. Am I onto something there?
100%. I think there's so many different layers where the AI is fundamentally better than what a traditional loan officer is able to provide when it comes down to debt consolidation. So first, like for the AI to effectively look at like 7 different other debts you have, your credit card payment, which is you're paying 22% on, your installment loan, which you're paying 15% on, your auto loan, and then instantly recommend to you which ones you should pay off and which ones you shouldn't with your HELOC. Like that's like multiple recursive math, right? Like on amortization tables that like even you and I, like we're like on our TI-82s, it would take us a while to do that, right? A couple minutes. The AI does it for you instantly. So it can give you a customized plan for every consumer. Second, the AI is not judging you. Like consumers fundamentally feel like slightly like queasy or even ashamed about like what they've racked up. Like when you actually see what is on your credit report and you say, oh my God, I owe this much money to all these people, you kind of almost don't feel it because you ACH or pay it off. Like it just comes out of your bank account, like kind of like almost a subscription. But when you actually see it all in one place, you kind of make you feel crazy. And it's great to have a partner that can help you figure out and answer these questions, right? Like, hey, I'm kind of planning on selling my car. So should I pay off the auto loan or maybe like not do it? Or, hey, my kid's got a tuition payment due. The government's getting out of the student loan business. I've got to get a private student loan. I think it's going to cost me 11%. Should I instead put that on my HELOC? You can ask it all the questions that you would be sort of insecure about asking. And it's got instant answers and it just does the math for you. So that's like number one. Like from a consumer standpoint, we see consumers way more comfortable with the AI than with a traditional loan officer.
So let's just sort of talk about that a little bit. My sense is whether you work directly or indirectly with these agencies like Experian, for example, you get your credit scores. I mean, that plays into this as well. Is there some relationship there, or is that just sort of, I don't know if it's public or not, so forgive me, but do you tap into that, or is there sort of a
Oh,
relationship?
I mean, we tap into all the third-party data sources out there. I think we've got over 200 third-party data sources where we've got instant integrations. So we get all that data for you. We don't need to ask you for it. We don't need to ask you for it. Like we just get it all for you. We're not asking you for forms. We're not asking you for like uploading statements and doing all that stuff. That's all in the past. That's like what a bank will do. We will just get it all for you, put it all in one nice format, show it to you, and you can just go click, 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 click. Can we like turn it up? And it'll show you your monthly savings one by one by one. And boom, like you've got your answer.
Let me ask you this. There's a saying that baseball is a regional sport. My sense is the housing market is extraordinarily regional. And, home prices in Westchester or in Bergen County, the price acceleration or depreciation is going to look a lot different than what might be going on in the Carolinas or in Florida or areas of Texas and those types of things. So to the extent that you can get granular there, that's very important to your business in terms of where these HELOCs are going and, the valuation of properties that are basically the foundation of where these loans are made. Can you speak to that?
The housing market is having challenges because fundamentally, like insurance costs have changed and they're changing so dramatically. So everything in housing, like for like a small group of people in New York and California, they pay all cash and their homes are an investment, right? For the rest of America, their homes are their number one asset. 85% of their personal wealth is in their homes. And a monthly a change in payment of $100, $200 a month in homeowners insurance can drastically affect the affordability of that house and for a future buyer and like therefore the home value. What's really interesting is we've made such advances with AI that for HELOCs under $400,000, we don't need an appraisal. Mm-hmm. It's able to go and capture home value and forecast and predict the home value today, and also what it's likely to be in the future with the effects of climate change, way faster and way easier than a traditional appraiser, right? Who's going to go to your house, look at comps, look at things that are like sort of local, and may not get all the pieces right. So I think that's like one of the other things that we've been able to do is to make the process instant. If we had to do a traditional appraisal on every home equity line of credit, it would be like $500 to $750 more expensive for the consumer, and it would take 14 or 21 days. I think, people, when they want to save money, they want to save money now.
When you think about I'm thinking as you're answering questions, the relationships you could potentially have with these insurers based on this data this treasure trove of data that you probably have at your disposal. I mean, is that something that you've thought about, or is that something that's sort of out there?
Yeah, I think one of the biggest things that we have built as a company over the past 10 years is this. We built our own origination system, Tin Man, and it does every part of the mortgage process. Every other mortgage company in America is on between 5 to 8 different systems cobbled together from the floppy disk era. And what we've built is this one machine learning driven matching engine between customer data, property data, and the fundamental investor criteria for Fannie Mae, Freddie Mac, FHA, as well as like 40 other investors in the entire mortgage market. And so we built as a machine learning led engine. What is remarkable was the advent of Gen AI. The Gen AI is we had this very large, clean set of learning data. So we had 6 million customers, we had 12 million recorded phone calls, and we're able to let the AI learn everything about the customer and what their preferences are locally, individually, by type. A 65-year-old retiree is going to have a different set of preferences and important things to them than, a 28-year-old like first-time home buyer. And so it's able to learn all of that. And then similarly, it's gone through over 1 million appraisals. Like not like just the appraised value. That's like one field. That's what's captured in every other system. But we're talking about the entire 110-page file that's called the Form 1004, the Universal Residential Lending Appraisal. And that, again, it knows more than anybody else can. And it's had benefit of all of this clean data to build and train on that system. And we do think that becomes really valuable as we build out our Tin Man business. And we're now partnering up with insurance companies, large fintechs, large mortgage companies to actually take the AI platform and help them be in the mortgage business in a better way. And we believe that's going to be a substantial part of our company's business model going forward.
Okay, as we're sitting here, I'm not asking you to play stock market. I'm not. But the question I'm going to ask you is, your competition in the space. You look at a Mr. Cooper, for example, which is, made some interesting moves. I think a $13 billion market cap, a stock that's had, I will say, a bit of a parabolic move over the last year or so. Who do you view? My instincts suggest that is a competitor, but not necessarily the only one. There's probably a lot of moving parts in terms of the competitive landscape. Can you speak to that?
I think that it's really great. I think there are competitors are one, like mortgage software companies like Encino, or what used to be called Encompass, which is now part of ICE. And so those companies sell software to, like, again, from the .com era or from the DOS era to other mortgage companies. And we believe we've got a right to compete in there and, and win. And that's a pretty large market, right? We're talking mortgages, $15 trillion plus market in the United States, right? Every mortgage is built on a piece of software. So one is that, like Tin Man competing with them. The second is like the servicers and originators like Mr. Cooper or Rocket. And what those guys have the benefit of is a pre-existing customer relationship. What they have the liability of is a loan that they have on their books. And so as rates come back down, these guys they just don't have an incentive to actually give you the best price on a refinance. Like, that's how BETR became one of the biggest refinance lenders during the last, boom. We went from 500 million of volume in 2016 to 58 billion of volume in 2021 because we had no legacy. Like, we could always give the customer the best price that they could get approved for. Whereas all the incumbent lenders, they're basically saying, oh, we have a loan with you at 7.5%. We're making a lot of money off of that loan. Oh, maybe we'll refinance you at 7%. They're not going to give you the current rate. They're going to give you a rate that like limits their iceberg from melting. And so we have a pretty significant competitive advantage and growth advantage vis-a-vis those other players. And then on the home equity space, there's a company called Figure that's going public. They're in their quiet period right now. We're about 1/5 their size. I think they're going public at about $4 billion valuation. I think they're growing like 35% a year. We're growing 260% a year. And so, and our direct-to-consumer business, even just within the past 18 months, is already 2/3 the size of their direct-to-consumer business, which they've taken 6 years to build. So we think like we have a real right to win across all of the software category, the origination category, and the home equity category.
You mentioned interest rates. There's this talk, and I'm not suggesting you're doing this, by the way, but if you listen to the pundits, I think it's preordained or just sort of taken as rote now that interest rates in the United States are going to come down based on, again, this jobs number that we got today. Right now, the market is pricing in 3 rate cuts this year, September, foregone conclusion, again in October. I think it's now north of 80%. And again, in December, no meeting in November. And there's a belief that if the Fed were to cut interest rates by definition and go lower, but probably better than anybody that, the Fed controls the front end of the curve. The market controls everything else. And the Fed cut rates in September and 10-year yields went from 3.6% to 4.5%. So the importance of forgetting about the Federal Reserve, just the bond market in general. I mean, how closely are you watching that? Because as I'm no doubt you've seen, European rates have been going up seemingly every day. Rates in Japan have been going up every day. There's something happening in the global bond market right now that I'll use the word is somewhat ominous. Thoughts on that?
I do think that the global bond market is really worried about the debt binge that has taken place in this country. And you can think what you want about the administration, but the fact of the matter is, Scott Bessent has been really focused on the fact that we cannot keep spending so much more than what we make as a country. And so, there have to be some way that we've got to figure that out. Interest burden on national debt is one of our largest spend categories. I think it's bigger than defense and almost the same size as like Medicare, Medicaid. And so from our perspective, if like everyone has an interest, particularly in the government, in bringing the short end of the curve down and the long end of the curve really, really down. And I think what we're going to see is concerted policy efforts to actually bring the long end down. I think the 30-year might take longer to come down than the 10-year. The mortgages are really built on the 10-year cycle. The other thing that's really interesting is what the Fed can do is they have been in a quantitative tightening posture for the past couple of years when inflation burst. If they go into a quantitative easing stance where they are actually become net buyers of mortgage-backed securities, that is another way that they can influence the housing market and without interest rates really having to cooperate, because what that will do is bring down the basis between mortgage rates and the 10-year, which today still is at pretty wide levels compared to where it was in 2020 and 2021. So I think those two things combined together give me pretty good confidence that I think you're going to see the 30-year mortgage rate that's today, I think 6 1/8 on better.com, like cheaper than other people, be in the fives, maybe 5.5 handle in the next couple of months.
I don't know this again, and I'm curious as to your thoughts, but you're probably at a bit of a sweet spot in terms of your business where sort of the yield curve is and where rates are. I think in a significantly lower rate environment, the decision's already made for people. Like there's no way to sort of discern one from another. But when you get into the areas we are now, it's sort of that thing where, you can stand out from your competition. Does that make sense a little bit?
You're so right. When people are feeling flush, they don't care about paying an eighth extra or a quarter extra, right? With their and not having to shop around. I think when people are feeling tight and they are looking for value, they're going to Walmart, they're going to Costco, they're going to the dollar store, they're coming to better.com because we have the lowest prices on the internet for a mortgage. And we back that up with our better price guarantee where we'll beat any competitor's rate. And so I think those things combined together are part of the reason why our business has doubled in the past year. And, I've been out there publicly saying it's going to more than double next year. And so, and I think that that's going to help us drive to profitability as a company and really start to regain the crown that we had where we were America's fastest growing FinTech over the 5-year period from 2016 to 2021. And we're looking to come back there.
Vishal Garg, the CEO and founder of Better Home and Finance. Fascinating conversation, wider range of topics. Thanks for joining us.
Thank you so much for having me. I'm so pumped to be here.